Welcome back to Inside Options. Thanks for joining me, James Boardman. We're talking options trading strategies with a real-life trader, Drew Markson. Now, Drew's been trading since 1989. He uses his own funds to do it, and he's still around, he's still trading. That tends to suggest there's a lot we could all learn from him. So we've been talking in the first half of the episode about trading in the States, trading on the floor, and that transition. So I've actually got a slide I'd like to show you of the guys on the floor. I mean, they're pushing, shoving. Drew, you mentioned you got stabbed with a pencil a few times.
That's correct, James. In fact, I think I see myself. That's me before I got the wig. That's me before the hair transplant. That's me.
Sleep deprived, sort of screaming. I mean, you can see the fear and greed in these guys' faces. So quite a stressful job. Then they transitioned to this. These calm, quiet, electronic screen trading. Different bunch of guys started trading as well. Younger, quieter, smaller guys, less forceful, less screaming, less sort of jocks, and more straight onto pricing nerds.
The tech guys, the nerds guys took over. The Bill Gates,
the revenge of the nerds. You know, that's across the world. That's what's happened. And there's this amazing transition. So, Drew, you came to South Africa. When did you come to South Africa?
I came over here in 1995 for a friend of mine's wedding, and we were sitting around in his apartment, and he was saying, you know, what do you do for a living? And I told him I was a commodity trader. And he said, oh, well, I've got friends that do that here in South Africa. And I said, no, you don't. And he said, yes, I do. And I said, no, I trade futures and options, not shares. You're getting it confused. And he whipped out a copy of the Business Day and showed me that, look, we trade agricultural commodity futures here. And then I decided to try to take a look at that and see if I could trade it.
And then sort of 97, 98, that market started getting going. But there were just futures. Interestingly enough, we chose the wrong products. We started on beef and potatoes, which didn't actually work well because they're different products, they're not very standardized, different qualities, different grades.
You're correct. The first two products they listed was a beef contract and a potato contract. They eventually phased those out, and the contract that really took off was the benchmark contract we trade today, white maize, grade 1. That is the main liquidity source on our exchange.
So that's our biggest contract, is the white maize contract.
Right now, that's the biggest contract, yeah.
And I mean, just to put that in perspective, the market, I was checking some statistics today, the average daily volume for June, 1.9 billion rand trades on it per day through that agris market.
Yeah, we trade several times the crop size in a week or in a day, and that's just a result of a lot of the different speculators or hedgers in the market adjusting their positions day to day. That's basically what's going on with all that volume.
And I mean, the other thing, it's a natural market, and that's what we hear about a lot, as opposed to shares, which is an unnatural market.
It is a natural market. That is a great point that you raise. What separates the agricultural commodity markets from other markets like shares or perhaps a casino is that it is a real businessman's market. When that farmer buys that option contract, he's using that option contract to get a minimum price for his grain and to get financing from a bank.
It's a business thing. He has to do it.
It's a business transaction driven by financing, and the option is the go-between that basically gives him the minimum price that the maize board used to in the past.
Exactly.
And that allows him to do a lot of things which have social benefits. It allows him to purchase the seed, purchase the fertilizer, purchase the diesel, hire workers, and grow food.
And get a bank loan. You know, and the bank would be unwilling to give him that loan.
Correct.
So it's a financing thing as well. Now let's look at one example. I've got another slide here of the one example we want to talk about, a long call. You were telling me earlier you're quite bullish on maize. So what are we going to do with this call?
Okay, in this example, I believe the price of white maize is going up. It's trading approximately 1760 rand per ton right now. I think it could go to 2,000, let's say, within the next 2 months or so.
Okay.
Not quite as sure about the timing, but a low-risk way to play this is by buying this call option that you've described here on the screen. Its strike price is right where the market is trading, 1760. It goes for about 80 rand per ton. We trade a 100-ton contract. That's going to cost a investor or a speculator about 8,000 rand to buy that contract. And that is the most that person can lose. So if they can afford that, they can sleep well at night.
My favorite thing, lopsided leverage.
They do have lopsided leverage.
So let's just look at that example there. I'll put it up on in text.
Sure.
So you buy the one call. It's about 4.5% of the exposure at the 1760 strike, going for about 8,000 rand when we looked at this. So at 1840 per ton, when the maize price goes up from 1760 to 1840, you'll break even.
Correct.
If it goes up to 2,000 rand per ton, you make 24,000 rand, less the 8,000 you paid for that call. So you make 16,000 profit, or 200%. And I mean, that's
correct.
That's some going, you know. And the worst that can happen, if it doesn't move or goes down, you lose that maximum of 8,000 rand.
You're right, because timing is the tricky part. We're not sure when the next upcycle, what will drive these commodity prices higher. Traditionally, historically, it's been weather. Droughts create the supply shocks that drive commodities higher, if I had to grossly simplify it. When could we be due for this weather type of problem? There's two chances. One is very timely. It's right now in the United States. They're in summer. They're in crop pollination. If they get a weather scare, the prices could explode.
Okay.
If that doesn't materialize, in December, January, February of next year, right here in South Africa, we can get an El Nino or some type of drought phenomenon which could cause the prices to explode.
A big impact.
Yeah.
So that's something you're constantly watching then, is the weather.
Weather,
as a commodities trader.
It is, because as you mentioned earlier in the other war story about orange juice, what was the driving force of the market movement? Weather. If you go back and look at charts of how these prices move for white maize, you'll see the biggest determinant, the biggest driver of these prices is a supply shock, courtesy of Mother Nature, in the form of a drought or an El Nino related weather phenomenon that causes the drought.
So the key thing is here that if it goes either way and you're kind of speculating, you want to be in options, because the most you can lose is that 8,000 rand.
Correct. You had mentioned, you said lopsided risk versus return. Exactly. I want to look for not high risk, high reward trades. I want to look for low risk, high reward trades. Options are ideally situated. I call it non-linear returns. The most you can lose is the 80 rand a ton. The most you can lose is the 8,000 rand. You can make, the sky's the limit.
Exactly.
In this example, we estimated the price might go up about 12 to 14% from here, 2,000 rand. Even with a 12 to 14% move, because of the leverage, the profit potential on these trades are triple digits, 200%. And we're actually being conservative.
And I mean, the great thing is this active on-screen market that you can go to a lot of different brokers.
Correct.
And you can go and trade this. You can look it up on the JSE's website. We've got a big list of all the different brokers you can trade with.
Correct. They've done a great job on the agricultural commodity division of replicating these options and replicating the pit that we had in the early days.
Electronically.
Plenty of bids and offers, plenty of trading you can do.
So sadly, that's it for tonight. And big thanks to my guest, Drew Moxon. We hope to see you again next week to learn a bit more about the fascinating world of inside options. Till then, from me, James Boardman, cheers, good night.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.